You're all very welcome on today's webinar. Really appreciate your time. Today's webinar is how financially successful people minimize tax and retain wealth. And it's funny because we do a lot of online content these days, and I saw somebody commented on a video we done the other day saying she doesn't agree with tax avoidance, but the reality is that tax is one of the biggest expenses we will typically pay in our life, and the government do give us very generous reliefs and allowances, which are completely legitimate as ways to reduce our tax. And naturally, as a financial advisor, we would always encourage people to really look at every option available to mitigate against the impact that tax has on our ability to, I suppose, maximize our wealth and also retain our wealth. So, look, hopefully there'll be some key takeaways in today's webinar to hopefully help people put those kind of things in place. So just before we move on, for those of you on the webinar who might not be too familiar with Alpha Wealth, who we are and what we do, we basically run a impartial financial planning and advisory company. And we've 10 staff members in Alpha Wealth at this stage who are all QFA and CFP qualified advisors. And basically we work with, individuals and families and business owners like people on the call and help you manage your money more effectively by providing specialist advice and solutions in things like financial planning, savings and investments, retirement planning and pensions, protection, tax, mortgages, everything really within that personal finance space. I'm happy to say we're celebrating our 10th year anniversary actually this month. We're celebrating it next Friday, and over that period we've amassed 4,000 clients from all around Ireland who now have over 250 million of assets under management with us. So we've a lot of experience, I suppose, helping people like yourselves manage your money more effectively. We are a central bank regulated company as well, just to mention. So the key takeaways of today's webinar, firstly, we're just going to be doing a quick refresher on the current Irish income tax system. Won't spend too much time on that. Then we're going to be focusing on some reliefs and credits that people can be claiming. There was a lot of, I suppose, changes on that front over the last kind of 1 to 2 years with rising interest rates, rent credits being changed and all that kind of stuff. We'll then be moving on to how you can shelter some of your income in tax efficient vehicles. We'll be discussing tax efficient schemes, such as a scheme known as the Employment Incentive Investment Scheme, or EIS for short, how people can operate a bit more tax efficiently by saving money on tax efficient protection policies, and finally just moving on to tax planning and reducing inheritance and gift tax for kids and relatives, which is becoming I suppose, a more prominent area to look at. I suppose if you think about it, the average price of a house now somewhere like Cork or Dublin, and you have maybe a family with only 1 or 2 children, even a very, very simplistic and everyday situation, those kids could be looking at a fairly hefty tax bill simply inheriting the value of the family home. And that's before we even go on to things like, money in the bank, other assets, pensions and stuff like that. And just to mention, I am joined by a number of my colleagues on the call today. So if anybody does have any questions throughout the webinar, feel free to pop them into the Q&A box, and we will allow a bit of time at the end as well for questions. Perfect, thanks. So look, not to bore people too much, but just a quick refresher on the current Irish income tax system and how we're taxed on our income, because there were some changes to that last year. So we have 2 tax rates in Ireland. One is 20% and one is 40%. Basically, a single person can earn up to €42,000 per year at 20% tax, and anything over that is 40% income tax. A single parent can actually earn up to €46,000, and one person in a married couple can earn up to 51,000, and as a collective, a married couple can earn up to 84,000 at 20%, with the balance being at 40%. And that doesn't include obviously USC and PRSI, Universal Social Charge and PRSI, which is in addition to the income tax rates. The changes were applied this year in terms of how much we can earn up to at the standard rate of tax. So back in 2023, 2022 and previous years, that was down at 40,000. People probably remember many years ago it was down as low as 36,000. So basically everybody in Ireland, well, most people in Ireland today are probably better off to the tune of about €70 per month this year versus last year. Just a quick note as well on the married income threshold of €84,000. There is actually a cutoff for the higher income earner at €51,000. So basically the maximum income that the second person can earn is €33,000 to benefit from the full 84,000 at 20% tax. So for instance, let's say if you have a couple where one of them is only earning €20,000, the other person can't earn more than 51,000 to avail of the full 84,000. So in that example, the max that they could earn at 20% would be 71,000. So as I mentioned at the start of the webinar, tax is the biggest expense that we will typically pay. Arguably, look, we have a very penal tax system in Ireland in that, we're taxed on our income. When we save or invest the money, we're taxed. And as I mentioned or alluded to earlier, if that wealth is passed on to future generations, it's also taxed as well. So if you have, let's say, a married couple in Ireland earning €150,000 per year, their total tax bill, including USC and PRSI, will be coming in over €52,000 a year, or 261,000 over the next 5 years, unless they find ways to shelter or reduce that tax. So it's an effective tax rate on their income of 35%. So over a third of their income basically is lost to Mr. Taxman. And if they decide to save or invest that after tax money, we're also charged tax on the interest, and that can range from capital gains tax or dirt tax at 33% right up to exit tax at 41%. Now, this isn't me saying that people shouldn't save or invest money. Sometimes we just have to take tax on the chin and accept that it's a reality of life. But there are ways, of course, to help reduce the impact of tax and tax efficient vehicles that we can pursue. And as I mentioned, when we die, the after tax money goes to our estate or family, where it's taxed a further 33% over certain limits. So it's really important that people know, I suppose, the impact and how to mitigate against it. So how can we act more tax efficiently and reduce the impact of tax on our ability to build and maintain wealth? So firstly, we have the small stuff like claiming reliefs and credits. I noticed that at the start of the webinar, nearly about half of the people that answered that poll said that they did not complete a tax return for last year, which is a bit alarming, because I probably go as far as saying that almost everybody in Ireland today should be due some amount of tax rebate or tax back from expenses and tax that they incurred in 2023. This is a snip of the My Account section of the Revenue website, and when you log in, you'll be able to basically do an online tax return for the previous year, and it's something that I would encourage everyone to get into the habit of doing. You'll notice that as you're going through the tax return, it'll go through various tabs. So there's your personal details, where you live, your date of birth, etc., your bank details. If anyone is in PAYE and employment, their income and their basically the employer should come up here in number 2. Number 3 that you move on to is non-PAYE income. So that might be like rental income from an investment property, maybe deposit interest, investment income. And number 4 is the important one that we want to discuss here today, and that's tax credits and reliefs. So you'll notice that there's a couple of different categories here which all have drop downs, and you'll see numerous things that you can claim tax back on. So for instance, last year I had health expenses myself of €447, as well as electricity bills and broadband bills that I was able to claim back on. Sorry, this was actually a couple of years ago. It was more again last year. These are all the things basically that we can claim back on over under the various categories. So if you look at your health, things like medical expenses and dental expenses, so that includes going to a GP, going to a consultant, non-routine dental work, paying for prescription costs even, all of those guys allow 20% back. So look, surely most of the people on the call today would have at least gone to their doctor once or got one prescription last year. You should be eligible to claim 20% of that back. If you look at things like you and your family, if you're putting kids through college, there are basically costs over a certain level which you can claim back on. Obviously, being married is very tax efficient, as we just kind of focused on in one of the first slides. But the two ones that I want to talk about are mortgage interest relief and the rental credit. So over the last, say, 12, 18 months, we went through a period where interest rates were hiked up at a fairly rapid rate, and a lot of people that were on tracker or variable rate mortgages saw their interest go up and up and up, or their repayments go up and up and up. Anyone who was who suffered rising repayments due to interest rate hikes is actually now eligible to claim back €1,250 as a mortgage interest relief credit. So if anybody on the call is in that cohort, I would get on that fairly quickly. And their rental credit as well, that was previously €500 per person, was also increased to €750 per person in the budget last year. So that means that a couple, let's say, who are renting an apartment or a house, are due back €1,500. And then if we move on to things like your job, you have pension contributions, which I'll be talking about in a second, flat rate expenses, which applies to people in certain occupations, and it gives you basically a tax rebate to help with the costs of, I suppose, maybe paying for tools, equipment, clothing in the job you're in. I remember years ago when I was working in I suppose bars and hotels and restaurants, we were able to claim back a couple of £100 every year to pay for um, anything that was involved in that. Remote working expenses obviously is something that's very relevant as well. A lot of people nowadays are working at home, either partly or full time. You can actually claim back 30% of the total cost of utility bills, broadband bills, electricity, all that kind of stuff. So as I said in the earlier slide, I would go as far as saying that almost everybody on the webinar today should be due back at least something from all of those things. And I would encourage everyone to get into the habit of doing a tax return online each year. So look, that's small stuff that we can claim back on. Look, it might give you a couple of £100 maybe at the start of the year. But if we want to, I suppose, reduce our tax at a larger level, we need to look at options to shelter our income in tax efficient vehicles. And for most of us on the call today, that's not a holding company in the Cayman Islands, but there are legitimate ways. The best way of reducing your tax, and probably the most underutilized way in Ireland, because people, I suppose, naturally don't really know how a pension works, and there's a lot of confusion there. But all a pension really is a long-term savings plan, and it is the most effective way of saving money and reducing your tax. How it basically works is that it allows you to save your before tax income into a fund, and those contributions build up over your working life, in addition to possibly employer contributions. You have the ability to invest those contributions in, pretty much anything you want. The options are endless. A lot of people refer to a pension being risky. That term doesn't make sense, because a pension isn't an investment. It's just a vehicle to invest in. So you can invest in anything from a 100% guaranteed cash fund right up to the highest risk investment possible and everything in between. But any interest that those contributions does earn, or has the ability to earn, is also tax free. Whereas anything you invest in outside the realms of a pension is taxed fairly heavily, as we said. And the other reason people, I suppose, ignore a pension is because they have this misconception that you need to be paying into it until 65 or 66 to access the money, which is not the case. Most pensions in Ireland can be accessed as early as 50. And at that point in time, you can take 25% of the future pot as a tax-free lump sum, and you draw down regular income from the remaining pot as you wish, likely at a much lower tax rate than your current rate. Another common misconception I see is people think that pensions are deferring tax. People say to me, okay, that's great, I get tax relief on the way in because I can save my before tax income in the pension, but then when I take the money out, it's taxed. And not really, because the average income in Ireland today is nearly €50,000, which means that the majority of people are eligible to get 40% relief on contributions to their pension. So I suppose if you add up the decades of tax savings on 40% tax relief, the decades of tax-free compounding growth, the fact that you get to take 25% of the future value, which is a much higher value than what you put in, get to take that out completely tax-free, and then you draw regular income from the remainder. And the fact is that you would need to have a significant pension pot, like I'm talking, close to 2 million, to be able to draw more than 42 grand a year. So the fact of the matter is that the majority of us in Ireland will pay very little tax on the future drawings from our pension in our later years, whereas, as I said, we would have benefited from the 40% relief on the way, and plus the tax-free growth. And
And
there's
David,
quite
can I jump in there? What about
yeah.
somebody that's working in sales? How are the percentages worked out? Is it off their base salary or their OTE earnings?
Yeah, it's your total income. Yeah, so you can see this scale here. So your scope to fund a pension is based on your age and your income, and it's your total income. So for those who are under 30 years of age, you can shelter 15% of your total income into a pension, and that rises on a scale to 40% for those who are age 60 and over. Now, you don't have to go right up to that level, but the advice is to maybe try to get as close to it as possible. Just a side note as well, your earnings are capped at €115,000 a year. So let's say you've a well-paid individual who's earning 150 grand a year, and he's age, say, 35, he can only put in 20% of 115k a year, not his total €150,000.
Perfect. Thank you.
Thanks, Lena. Just to show you the impact, I suppose, of making even, moderate enough pension contributions, we're just comparing the situation here between two 40-year-olds who are earning €60,000 per year. the first person, she's coming out with take-home pay of about €43,200 a year, which is in net terms about 3,665 per month. So she's not paying into a pension. She's losing nearly 12 grand a year to income tax alone, in addition to USC and PRSI. She's only going to get the state pension of 13 grand a year at age 66, which, look, I don't have to tell people that that's not enough to live on comfortably, not in Ireland anyway. And any money she saves or invests from her take-home pay is taxed at 33% or 41%. If you compare that situation to somebody who maybe looks to shelter 15% of their gross salary into a pension, their take-home pay is €37,000, sorry, €37,800 a year, or €3,215 per month. So basically, they're saving €450 per month of their take-home pay, which is just over €100 per week, but they're actually getting €750 hitting their pension account because of the 40% tax relief. And as I said, that money grows tax-free. They're actually saving 3,600 per year in income tax, which is actually reducing the income tax by about 7% versus the person on the left who's not making pension contributions. Even a modest enough investment growth rate of 6% per year, which is very, very achievable, by the way, and I'm happy to show anybody, as to why I'm saying that. But they're going to accumulate a pension pot by age 65 of 456,500. As we said earlier, they get to take 25% of that tax free, which is 114,000. And then they have a fund of about 342 grand that they can draw down as a regular income. And just going back to what I said earlier, like even if you're taking 10% of that per year, which is a lot, that's only giving you income of 34 grand a year, which is well underneath the 42 grand standard rate cutoff. So this person is benefiting from 40% tax relief on the contributions going in, saving him, tens of thousands in tax. He's benefiting from decades of tax-free compounding growth. He's getting 25% out completely tax-free, and now he's only paying 20% income tax on the withdrawals on a much bigger fund. So you can just see, I suppose, the impact not only on saving tax now and ongoing, but the difference in terms of their future financial security and the ability to retire earlier and much more comfortably than the people that aren't funding pensions. What people can also do, naturally, most of us would be familiar contributing to a pension through our ongoing salary. So you're getting the tax relief automatically at payroll. Your employer is deducting you, 5, 10, 15% of your income, and you're not even seeing it. But believe it or not, you also have an ability to make a lump sum contribution from funds that are in your bank account into your pension and backdate that contribution to last year. So let's just say I have €10,000 in a savings account that I don't really foresee me needing. I can transfer that 10 grand into my pension scheme now. And once the money hits the pension, I can go online and do a tax return for 2023. Like the slides I showed you earlier, there's a section on that online tax form that you can include a lump sum contribution. It's called an ABC. Within a few days of submitting your return, Revenue is going to return you €4,000 to your bank account. So it's costing you just €6,000 to put €10,000 into your pension. And as we mentioned already, that €10,000 grows tax-free to your retirement. So basically what you're doing there is Revenue are actually returning you 4 grand of the income tax that you suffered last year for putting €10,000 into your pension. An absolute no-brainer for people that have, large amounts of money sitting on deposit.
So David, 2 more questions there have come in.
Yep.
Can you have multiple pensions? Is there a max on a corporate contribution, per annum? Thus the need to take a second if 25% of the 115k, I think that was just on your last slide with the example.
So firstly, the first part of that question, you can have as many pensions as you want. You don't have to keep amalgamating all your pensions into the one arrangement. It's not uncommon that people would have 2, 3, 4 pensions over the course of their careers, changing jobs. It's actually quite advantageous because you can actually draw them down at different points in time to kind of facilitate a phased retirement, and anything that you don't draw on kind of remains to grow tax-free. The second part of the question is those figures that I showed you earlier on that scale, that does not include an employer contribution, which is very important. The employer contribution is very, very generous. It's actually a lot more than this. So your employer can be contributing quite heavily into your pension, and you can also be maxing out on your side.
And the other one is, if you have mostly rental income, Is there any point in paying into a pension? I know you're going to cover off EIS in a while, but
Yeah.
can you maybe address that?
Yeah, no, good question. So rental income for the purpose of pensions is not classified by revenue as earned income, and therefore it's not pensionable. So if your only income is rental income, you can't shelter some of that in a pension, but you can shelter it in other tax efficient schemes, which I'm going to talk about in a second. Now, if you're somebody who's earning a PAYE income or some other form of income as well as getting rental income, you can make contributions relative to your, let's say, your other income. So like if you have, I suppose, a job paying you 50 grand a year and you're also getting rental income, you can kind of put some of that rental income into a pension once it's within, let's say, 20, 25, 30% of your 50 grand from your other job. But if it's your sole income, it's not pensionable.
And what happens if somebody dies before the age that they can draw down their pension?
Yeah, another common misconception people have with pensions is that the money dies with you. It doesn't. If people die before retirement, usually the full value of the pension is paid as a tax-free lump sum to your estate. If you die after retirement, your tax-free lump sum's already in your bank account, which goes to them if there's any left, and whatever's in the remaining pot that you're drawing down annual income from, your spouse or your family or your estate inherits the value of that pot, and they take over the income withdrawal. So pensions don't die with you. Okay. Hopefully that answers that question. So I appreciate that there might be some people on the call who are maybe, company directors or company owners or operating a limited company in the course of their employment. And a pension can be a really efficient way to tax efficiently extract wealth out of your company, because if you are in, I suppose, the fortunate position where you have company profits sitting in the account, the way I see it, you've three options. Your first option is to draw that money out as a salary or a bonus or dividends, where you're going to lose 50% to income tax, USC and PRSI. So that's 40% income tax plus UNC and PRSI. It takes the total rate up to about 52%. So if you're already a top rate taxpayer, you take 10 grand out of your company and you see about 4,800 of that. And not only that, but the company needs to pay employer PRSI of about 11% to pay you that 10 grand. So it costs the company about €11,000 to pay you that 10 grand, and you only see 4,800 of it. You can decide to leave it in the company, of course, where it loses corporate 12.5% to corporation tax. You possibly might be paying close company surcharge as well, and it might just be sitting in a company bank account earning, little to no interest. There is a third option where you can extract the money out into a pension in your name, and that full contribution arrives into your pension, which grows tax-free to your retirement, which I mentioned can be as early as 50 onwards. There's no income tax in your hands, and there's no employer PRSI or corporation tax for the company. There was a very, very important change to pensions legislation in 2022, which now allows company owners to extract unlimited amounts of profits from their companies to a pension or a retirement account in their name. But not only that, they can also do it for a family and employees of the company. So whereas previously you were capped, like the limits I showed you earlier, if you're now a company owner in a company that has quite a lot of cash in the account, it's a strategy that I would definitely be pursuing, because as crazy as it is, the situation we're in now is you could literally pay yourself 100 quid a month, your two children 100 quid a month, and your spouse 100 quid a month, and literally drop 2 million into a pension pot for all four of you, even though you're drawing a very modest salary. It's an insane situation, but it's the situation we're in, and it's something that I would be, I suppose, grabbing with both hands if I was somebody in that position, and I'm happy to discuss it in a bit more detail. Just before I finish up on pensions, I don't want to labour them anymore, but the final point I would give is not all pension funds are the same. You have good pension funds and you've not so good pension funds. And one thing I would encourage everyone on the call to do is get into the habit of reviewing their pension schemes and get advice from an independent or an impartial provider. There's no point going to, I suppose, a bank or a tied agent for pension advice, because you're not getting the whole market offering. In Alpha Wealth, we're not tied to any providers in the market. And as you can see here, there's a massive variation between the returns of different funds. All of these funds are from different fund managers. There's loads of different fund managers, loads of different funds in the Irish market, endless options. But I meet a lot of people that have their corporate pensions with Irish Life. All of these funds, by the way, are a risk level 5 fund. That's a moderate to high risk fund, 5 on a scale of 1 to 7. And the reason I've chosen that is because it probably would be the most common risk band for people with pensions. It's probably suitable for anyone in ages between 30 right up to mid 50s, depending on when you want to retire, of course. But you can just see here that the Zurich Prisma 5, which a lot of my own pension is in, has done 63% over the last 5 years, whereas the same risk level Irish Life funds have only done about 25 to 37%. You'll see that even within Irish Life, they have two different funds here that are both risk level 5, but there's a massive difference, about 12% difference in returns between the two risk level 5 Irish Life funds. A lot of other clients might have their pensions with Mercer. You can see their high growth fund here, also risk level 5 has done 37%, whereas other providers like Aviva down at 30%. So like you could literally be costing yourself tens of thousands of euro to hundreds of thousands of euro over time by not making sure that you're in the right fund, not getting advice, and not switching to the best performing funds in the Irish market. And I can give people more advice on that if they want to link in on a one-to-one basis after the webinar.
And David, just before you move on to
Yeah.
the next slide, what age can a company director start paying their children?
I think I believe it's from 16 onwards. I could be correct. Sorry, I could be incorrect there, but
We can check that
I
out
think it's
and we'll revert
16%,
on the
16. Yeah,
chat. Yeah, no
no
problem.
worries at all. Yeah. So I mentioned at the start of the webinar and in response to that question earlier that there was another tax efficient scheme that people can avail of outside the realms of a pension, and it's a scheme known as the Employment Incentive Investment Scheme. This allows you to shelter all types of income in it, including rental income or even, believe it or not, drawings from a pension, so pensionable income in your later years if you are a lucky person who is paying top rate income tax on their pension drawings. It's basically a revenue back scheme which allows you to invest money with qualifying Irish companies, typically over a 4 to 5 year period, and you can avail of a tax rebate on your investment amount up to as high as 50%, which is given in year one. The minimum investment per company is relatively low at €5,000 per company, so it's not, I suppose, outside the realms of possibility for a lot of people in Ireland. But outside of a pension, it is the only thing that exists in Ireland to get tax back at a high level. And just to note as well, those limits that we referred to earlier on pensions, they do not extend to EIS investments, so you can max out your pension and do EIS investments on top of that. The relief that you get is kind of tapered down, and it's dependent on the company that you invest with. So its revenue would set the relief. So if you're investing, basically the government's intention is that they're trying to flood more funds, or I suppose capital, to early stage or startup companies. So a lot of those companies now will avail of 50% relief, whereas if you have more, say, established companies that have a track record, it's 20% relief, and there is a mid-tier then as well that gives a 35% relief. You also get potentially a coupon or a return from the company that you invest with at the end of the term, which is 4 to 5 years, as I said, which is typically in the range of about 25 to 30%, but it can differ. So let's just say you have an example, so you have a company which is going to give you a projected return of 28%, and an investment in that company qualifies for 35% relief. This is how the maths would work on a €5,000 investment. So you invest €5,000 this year, and at the start of next year, revenue returns you €1,750 in a tax rebate, which makes the net cost of the investment just €3,250. Or some people would look at it there as they're just risking, say, 65% of their investment because 35% of it is guaranteed through the revenue rebate. All going well in year 5, you'll get your €5,000 returned in addition to a 28% return, which is €6,400. So if you think about that, you made an investment which had a net cost of just €3,250, and that potentially grows to €6,400, which is nearly a double your money scheme. So it's a really, really potentially lucrative scheme, and something that I would encourage any top rate taxpayers in Ireland who have maybe large balances, well, even, any kind of balance sitting on their account that they don't foresee them needing in the next couple of years. There's loads of different companies every year that raise EIS capital. Some of them are early stage startup, as I said, but some of them are really strong and interesting companies. And this is just, I suppose, a blend of some of the companies that we would have raised money for in previous years. We have a lot of experience, I suppose, dealing with this scheme. And what we do in Alpha Wealth every year is we will, I suppose, basically look around at some of the companies that are trying to raise EIS capital, vet the companies and cherry pick the top maybe 1 to 2 to 3 companies every year as a viable option for our clients under the scheme.
And
There is a,
David,
yes,
sorry, I'm going to jump in with another question that's come in. Can somebody invest company funds into the EIS scheme?
good question. No, it has to be done through personal monies. Okay. Now, look, I won't spend too much time on this, but funnily enough, what you could potentially do is say take money from your company account. Let's just say you gave yourself a bonus of 10 grand. You lost, let's say, roughly 5 grand to Mr. Taxman. You could reinvest that net €5,000 in an EIS scheme and basically claim back the tax that revenue would have charged you on taking that money, as well as getting the return from the company all going well. So basically what you're doing there is you're kind of utilizing the EAS scheme as a tax reduction or a wealth extraction tool. Look, it's not suitable for everyone, but it's just worth noting. But yeah, it only extends for personal monies.
Okay, thank you.
Perfect. There is a brilliant EIS opportunity that we have available this year, and it is, early days in the year, so there might be some others as the year goes on. But there is a company called 5 Mile Concepts who are actually run by the operators of Clishta Hospitality Group, who are one of the largest hotel hospitality chains in the Irish market. They manage about close to 20 hotels, bars, and restaurants across Ireland. But last year, basically, they done an EIS raise to acquire a building and a site called the 2 Mile Inn just outside Middleton in County Cork. It's on a national road, fantastic location, just behind a planned greenway cycle track. And this year, they're basically doing quite extensive renovations on that building to launch a new to market cafe, bar, and restaurant. They're also, after creating a coffee roastery and a barista training center on the site, and they're now making the coffee there. So they're importing the beans, making their own coffee. The coffee is trading under 5 Mile Coffee, and that's currently being distributed through the Clishta Hospitality network of hotels, bars, and restaurants, with plans to extend that out to, I suppose, independent cafes and restaurants and bars across Ireland as well. So I suppose what you have here is a venue being launched to market, which is giving, I suppose, multiple different revenue streams from the coffee roastery side of things right to the bar, gastropub and restaurant side of things, and the cafe. But basically, they're looking to raise further funds this year to complete the build of the bar, restaurant, and cafe. And the terms of the investment are actually, as I set out here on this example, they're projecting roughly 28% return over a 5-year period. And they have got confirmation from revenue of a 35% relief for any investments made into the company. This is just, I suppose, some images of the proposed build, which is actually now started. It's going to be trading under the name The Fork and Wheel. Perfect. So look, if anybody wants to discuss that in a bit more detail, look, feel free to link in with us after the webinar. Just moving on to just operating a bit more tax efficiently and maybe certain policies or plans that you're paying for. We have seen a lot of people, I suppose, that maybe took out a mortgage through a bank, and they were sold a policy called specified illness cover, which basically pays a lump sum in the event of sickness or potentially impacted from injury, but it does not allow any tax relief on the premiums. But there is another protection policy called income protection, which firstly provides long-term protection because it allows you to insure a portion of your income each year, and it keeps paying you that income until you're either fit to return to work or you reach the benefit end age, which I typically structure to be 65 or 60 to kind of ensure your working life. But income protection actually allows you to get either 20% or 40% tax relief on the premium. So it's a really tax efficient comprehensive protection policy to have. And now a lot of people will have this through their employers, but if you're self-employed or in a company that does not have a benefits package plan in place, I would highly recommend to look at this. Or if you have specified illness cover, as I said, it might make sense to change to income protection. Now, some people might need both. Some people income protection might do, but as I said, it's a much more comprehensive policy, and it does allow you to get tax back on the cost of the premiums. Um, the other thing is something called pension term assurance, which has nothing to do with a pension, by the way, funnily enough. It's basically tax efficient life cover for people who are either self-employed or in non-pensionable employment. It works the exact same as normal life cover in that it pays out a lump sum to your dependents in the event of your death, but allows you to qualify for 20% or 40% tax relief on premiums. So if anybody is self-employed or in non-pensionable employment and is paying for life cover, I would recommend to review that with the, I suppose, with it in mind to explore if you can move over to a pension term assurance policy to qualify for 20% or 40% relief on the premiums. Alpha will, by the way, act as an impartial broker for a lot of these types of protection policies, so we can help people get the lowest premiums in the market there, heavily discounted, and offer you advice around that. If anybody is operating a company, as I said earlier, you can also affect something called executive pension term assurance, whereby you structure life cover through your company rather than paying for it yourself. It's deductible for the company for corporation tax, and in the event of your death, it will pay a lump sum up to a maximum of 4 times your salary to your dependents, completely tax-free. The final piece I'm just going to focus on is gift and inheritance tax. And again, people probably mistakenly think that this is something that only the rich or the wealthy need to be worried about, but there's not a lot of leeway on how much your, let's say, your estate or your dependents can receive from you, either as a gift or on debt. So we've 3 different tax-free thresholds against capital acquisitions tax. We've group 1, which is children, which is €335,000 from the set of parents. It's not doubled for both parents. You've group 2, which covers things like siblings and grandchildren, which is just 32,500, and then you've other, which is 16,250. As shocking as it is, others extends to maybe couples that are in a cohabiting relationship and is not married. So there's some really a need to get proper tax planning advice there if you find yourself in that situation. But as I mentioned earlier, if you look at the average price of a house in Cork or Dublin nowadays, it's probably going to likely be well over 335,000. So if you have 1 child or potentially even 2, not to mind pensions built up, money in the bank, other assets, a lot of families nowadays their children are going to be looking at a fairly hefty tax bill on inheriting their estate. Now, there is things you can do to mitigate or minimize the impact of tax on your estate. One very underutilized but very powerful exemption is something called a small gift exemption, which basically allows anyone to give anyone else €3,000 tax free. And the idea here is that you can gradually transfer wealth onto children, grandchildren, relatives over a period of years, as to basically dilute your estate in the long term and hand more money to them completely tax free that does not eat into the thresholds above. So for instance, if you have, let's say, grandparents who have fairly large assets built up and are concerned about their children and their grandchildren receiving that estate and suffering a fairly hefty tax bill on it, they can give, let's say, €3,000 to the son, €3,000 to the son's wife, from both the mother and father. So that's 6,000 to, let's say, the son, 6,000 to his spouse, and 6,000 to each set of kids. And you can do that every single year. So you can just imagine that, what seems like a low amount can actually multiply fairly quickly, and you can pass on fairly significant amounts of your wealth gradually over time.
And David, can this be backdated? So can the
No,
small gift exemption, it can't be
no,
backdated?
yeah, it can't be. It can't be backdated, which is why it's really important that people meet with kind of a financial planner or a tax advisor to, I suppose, look at I suppose maybe calculate any tax liability that your estate might be looking at, and look for ways to, I suppose, put a plan in place basically to maybe reduce the impact of it, because you can't go back in time, unfortunately. You need to put plans in place.
And another question, if grandparents are not Irish residents, can they still give this small gift exemption?
If they're not Irish, You probably need to get specific tax advice around that. My guess would be that they could, but there might be some other tax implications in the country that the grandparents are based in that might come into play. If you flip the scenario around, if you have, say, grandparents that are in Ireland that have, say, children and grandchildren abroad in another country, again, there might be some tax implications in the other country that you need to bear in mind. So
And
that's
I'm
a
just
bit
going
of
to
a,
address the questions that are coming in around this
yeah,
before we move on, if that's okay. Can the
yeah,
money
yeah,
be
sure.
paid into your child's bank saving account?
Yes, see, this is the thing. It has to go into an account in their name, and there's specialist kind of trust accounts, which I'm just going to be touching on in the next slide, to allow you to do that in a really efficient
And
way.
can the gift be given out of your gross income?
No, no, it's like it's money in the bank and assets and stuff like that.
Perfect.
Yeah, so sorry, just to avoid any confusion here, what we're trying to avoid or what we're trying to reduce here is the future capital acquisitions tax that our children or grandchildren or estate are going to pay on receiving money or assets or inheritances from us. It's not to reduce, income tax for us now.
And can this gifted money be invested? So you've said it has to go into the child's account.
Good question. Yeah.
Yeah.
Any time you put money away, whether it's for yourself or somebody else, I want you to ask yourself the question, what's the likelihood that this money is going to be sitting in an account for, say, 4 years or longer? And if the answer is very likely, you need to invest that money to make sure that it keeps pace with inflation and grows. Whereas if it's something that the person is going to receive or you're going to need in the next 1, 2, 3, arguably maybe 4 years, it's fine just putting it into like a bank account or a credit union. But as we've seen, inflation can erode the value of those savings quite heavily over time. So bank accounts, credit union accounts, and post accounts, they're not really suitable
And what
for
are the options then that
long
you'd
terms.
suggest?
I might just leave that till the next
Yeah,
slide, Cliona, and
no
I'll
problem.
touch on that. But thank you very much for the question. Look, and I'll answer it there in the next slide just once I get past this. But this example here just kind of breaks down what I'm talking to. Let's just say here, look, we've a couple, Mary and John, who have €50,000 that they want to pass on to their grandson Luke, who's age 13. So they want to give him the money when he turns 18 to help with college costs, student accommodation, and a car. As Luke falls into Group B threshold, he can only receive 32,500 tax-free now under CAT rules, and he'd have to pay 33% tax on the remainder. So basically, Luke, the grandson, would have to pay a tax bill of €5,775 to receive the €50,000 from his grandchildren. Luckily, Mary and John sought some good advice years ago, and what they done is they set up a trust account now for Luke and decided to pay in €500 per month under the small gift exemption, which is basically €6,000 a year or 3,000 from each of them, as I said earlier. Let's just say the account earns a net interest rate of 3.5% per year. So after 5 years, when Luke is 18, it's worth 32,733 after they paid in 30,000. So now Luke is able to receive the full value of the plan, which is 32,733, completely tax-free because all of the contributions and the growth even counts under the small gift exemption, and he can actually receive an additional 32,500 completely tax-free from his grandchildren outside of that because the monies that he's received do not eat into the CAT limit. So now the full 50,000 can be passed on to him without giving rise to any tax or any lost 5,700 there, just with some proper planning and advice. So just in response, the last question there, Cliona, how can we ensure gifted monies grow? Many of the insurance companies, well, not many of them, but some of them have specialist accounts for gifting sums of money to minors if that money is going to be, put away for a long period of time. And this is something that might, I suppose, pique the interest of a lot of people on the call today who might have, young children and they want to maybe put some provisions in place to help them buy a property down the line, because we all know how challenging it is. You can't really, it's not effective really, and it doesn't make sense to just build up money on your account and just give little Johnny or Mary 50 grand once they turn 24 or 22 or whatever, because that's going to eat into their 335,000 threshold, as we said earlier. What I would encourage parents and grandchildren to consider instead is setting up basically an account from Zurich called the Child Save Plan. And how it works is that the account is in your name, so you full control now. You can increase, decrease, stop, take the money out, but basically it's put in trust for the child. So once they turn a certain age, they become the beneficiary of the plan. And once you keep the contributions under €3,000 per person, which can be 6,000 per year with a couple, they inherit, sorry, not inherit, they basically receive the full value of that, like the previous example, without eating into their capital acquisitions threshold. Now, why I'm suggesting to use this plan from Zurich instead of a bank account or a credit union account is this plan gives you the ability to invest those contributions in a wide range of market-leading and award-winning savings funds from Zurich with exceptional long-term track records. One example is a fund called the Active Asset Allocation Fund, which is one of Zurich's main moderate risk funds. So it's a really well-diversified portfolio. It only has about 40% in stocks and shares, about 40% in government and corporate bonds, a bit of property alternatives and cash. So really well diversified. And that fund over the last 5 years, despite us having a global pandemic which shut down the worldwide economy and a war in Ukraine, and 2022, which was the worst market year we had since 2008, despite all that, it returned 43% for investors, which is an annualized return of about 7% per year. The fees are about 1%, so basically investors would have benefited from about 6% per year after charge return in that particular
David,
fund.
a question has come in there. Are all of the trust option at risk investments? Are there any with a guaranteed rate of return or security of your initial investment?
Yeah, there's loads of different fund options. So there's a cash fund, which is guaranteed and low risk, but the risk level you take should always be based on one thing and one thing only. It shouldn't be based on what's in the news or how you're feeling about a particular event. It should be based on the time frame ahead of you. So if you are starting this for very young children or very young grandchildren, it is advisable to invest the money to make sure that it keeps pace with inflation, because as I just described earlier, markets will tend to move upwards over a medium to long-term period of time, despite there being occurrences of short-term volatility caused by, certain events, whatever the case may be,
And what
COVID
about
or
gains
otherwise.
on these funds? Do kids then pay the tax on this?
So with these particular accounts, they're actually structured very conveniently in that once the money is encashed, Zurich pay the tax on the interest and hand it over to revenue. So all of the returns and the capital invested is paid out basically net. So you don't need to do any tax returns, and it's very I suppose easy for both the individuals and whoever is receiving the money there. Because it's outside the realms of a pension, as I said, you will pay tax on the interest, but they don't pay tax on receiving the value of the amount that you invested and the after tax interest. So the interest itself here is liable to exit tax, but the point is that you're getting an after charge, after tax positive return, which outperforms long-term average inflation rates, which is what we all want to achieve, surely. Just moving on for larger gifts, there is a final relief that I'm going to discuss called Section 73 relief. So basically, if you think about it, if you're planning giving somebody, a fairly large amount of money or a large asset, they're going to be hit with a fairly hefty tax bill. And if you give them money to pay that tax bill, that in itself is going to be taxed as well. So there is something you can do to avoid that, and it's basically by putting money into a plan which is included under something called Section 73 relief. And just to explain it a bit better, I'm just going to look at an example here. Okay, so let's just say Mary wants to gift her son Tom a house worth €500,000 in 8 years' time. But she also knows he will need money to pay the gift tax. If Mary gifts him this money, it could create an additional tax liability. So as we can see down here, value of the house 500,000. He can only receive 335 grand of that tax free, minus the small gift, the annual gift exemption. So basically, he's to pay 33% tax on 162 grand. Therefore, resulting in a tax bill for Tom of 53.5 grand. So what can Mary do? She can basically affect a plan now, a Section 73 plan, where she saves, let's say, €6,683 per year over the next 8 years. And because it qualifies for this Section 73 relief, once she pays it in for a minimum of 8 years, Tom can actually receive the future value of the Section 73 plan. And once it meets certain conditions, he doesn't pay. By the way, the figure of 6683 multiplied by 12 results in about 53,500 euro. He doesn't receive, sorry, he's not taxed on receiving the future value. So basically, Mary can give Tom an amount of money to help him pay the tax bill on receiving the house without that amount of money falling subject to further tax. So another really tax efficient planning strategy there, and something that people should obviously get a bit of advice on. So look, just want to wrap up all that and close out by, I suppose, mentioning that in Alpha Wealth, we operate a kind of, I suppose, a very broad range of financial planning and advisory services, not limited to advice around pensions and tax reduction. As I mentioned at the start, we look at, I suppose, a holistic approach for our clients, covering everything from, savings and investments to protection insurance to high interest paying deposit accounts to, tax to mortgages to everything within that space, really. And we offer a full financial planning consultation to clients, which usually comes at a cost of €199. But for anyone who attends these webinars, they get a reduced cost of just €99. In our experience, we've saved or made clients thousands of euros in this process. I've never met a client that I couldn't save money for, or I couldn't improve their situation. So if anybody does want to get in touch with us after the webinar to maybe arrange something like that, we're happy to offer that discounted consultation fee, which, as I said, covers all subsequent meetings, advice, and setup of any plans if necessary.
I have another question for you there, David, which came in just earlier. And what's the best way, to mitigate tax on shares and or crypto? Can you give a bit of advice on this?
Yeah, so if you have shares or crypto where you're in the fortunate position that they've grown in value, you'll have to pay capital gains tax of 33%. There is an annual exemption against capital gains tax, which is €1,270. So the advice we usually give to people in that situation who have maybe a lot of, I suppose, company shares, is to sell them every single year to benefit from the €1,270 tax-free gains, because it can't be backdated. It's use it or lose it. And it makes sense as well to sell your shares ongoing to diversify your exposure to that particular stock, and maybe looking at diversifying. There are other things you can do as well. So basically, any previous losses can potentially be offset against future gains on things like shares or crypto or properties. So let's just say you have a share portfolio and you have some underperforming shares and some other shares that are performing well. You can actually sell the underperforming shares at a loss, sell the other shares at a profit, and offset the loss made on the other shares against the profit on the performing shares. Those losses, by the way, can be carried forward in, I suppose, indefinitely. So, you could have losses from maybe selling a property at a loss, 20 years ago, and you can still offset that against future gains. Of course, important to get, proper tax advice there.
Brilliant. Thanks, David. That's it with all the questions. I'll hand it over to you to wrap it up.
Perfect. Look, thanks to everybody for taking the time to jump on and for all the questions. Look, really do appreciate your time. My own contact details there are on screen if anybody has particular queries on either anything that we addressed in the webinar or any other areas, or if you'd be interested in booking in for a financial planning consultation, we can discuss that in a bit more detail with you. Otherwise, look, thanks for your time and enjoy the rest of your day.